Howdy, boys and girls. I'm Raymond Dahlman, president of DSA Financial Group, and this is the weekly wrap-up for February 25th, 2022. I hope everybody had a great week out there. It's been kind of a crazy week with Russia-Ukraine. The markets have been all over the place. See what else is going on. Oil and gold and silver prices have been really volatile. They've been really high. They've fallen back down. So just an all-around wild week in the markets and really the world. So me personally, I'm not too worried about Ukraine and Russia. That's a them problem, not so much an us problem. So I know the U.S. likes to get involved in everything, but I saw there was a meme going around yesterday, and it was George W. Bush saying that he admonishes this attack on a foreign nation. It's like, and it had the little monkey guy giving the kind of the crazy look. It's like, I remember Iraq and weapons of mass destruction, and those were lies. So my wife was asking me earlier, is anyone on the side of the Russians? And I was like, well, I don't know if I'd say I'm on the side of the Russians. I just, I know I'm not on the side of the U.S. government because they pretty much lie about everything. So if they're against Putin, odds are he's probably not that bad of a guy, and anything they're for, is probably the wrong thing since they're all a bunch of criminals. All right, well, let's take a look and jump in and see how the indexes did today. Let me let's see if I can make this bigger for you. No, that's not what I want to do. There we go. All right, the Dow Jones was up 2.51% today, closing at 34,058. S&P 500 up 2.24, closing at 4384. NASDAQ was up 1.64 today, closing at 13,694. Small caps are also up 2.26. The VIX was down 9%. Very good, down to 2759, which is always a positive thing. All right, so we see across Europe, greens, and we can see here the two Russian indexes. If you remember yesterday, they were down like 33 and 39%. Today, they've rallied 20 and 26%. So nice rally there. In their markets, I'd imagine they're probably going to bounce back fairly soon. Let's see what other ones were down. Israel and Saudi Arabia were down, but everything else across the Asian markets, except for Hong Kong and the Hang Seng, was down, but everything else was up. Starting in the Asia markets overnight, moving into the Eastern European and Western European markets, they were all up 2%, 3%, 4%. And then here domestically, if you recall, we were actually finished the day up yesterday after such a bad day. And then, and so again, today to have another up day is some positive news. All right, well, let's take a look and see how the markets did for the week. See here, the Dow Jones looks like it's going to finish the week up 0.25. The S&P 500 up 1.23. NASDAQ. All right, let's see here. NASDAQ was up 1.23 also. The Dow Transports 168, and the Dow Utilities finished up 2.51%. So, for all the volatility and stress and worry we've had with Russia, Ukraine, and then before that with the Fed, I'd call this not too bad of a week all in all. I was a little surprised to see the markets jump so much today, but it is and yesterday, but those things do happen. So, all right, well, let's take a look at the jobless numbers. They came in at 232,000, or the initial jobless claims. Forecast was 235. Last week's numbers were revised up from 248 to 249. So not a huge change from last week, even though last week's numbers were not all that great. Continuing jobless claims came in at 1.476 million against a forecast of 1.58 million. Last week's numbers were actually revised down from 1.593 to 1.588. So much closer, or takes, actually, that is a good thing, going down, what is that, about 5,000? All right, let's see. The U.S. Manufacturing Purchasing Managers Index came in at a 57.5. Forecast was 56, so slightly above forecast. And we can see it's made a jump up from last month from 55.5 to 57. So that is certainly some good news. The Consumer Confidence Index is up to 110.5. The forecast was 110. Last month's number, let's see, we were at a 113, so we went down to a 110. But still fairly close to the previous few months. So I don't see that as a huge problem there. GDP quarter over quarter came in at 7%. Forecast was 7%. So right in line with where we've been, 6-7%. We did have that drop off at the end of December, but all in all, things still look pretty good there from a GDP perspective. I would imagine things will probably slow down a little bit with the interest rate hikes and such that'll be occurring sooner than later. U.S. new home sales, 801,000 versus a forecast of 806. So just about on forecast, down about 10,000 from last month, but still up from November and December. And let's see here. Consumer sentiment came in at a 62.8, above forecast of 61.7. And but we can see that consumer sentiment's been falling the last few months. So I think people are kind of bracing themselves for what is in store for us coming up. All right, U.S. durable goods orders month over month was up 1.6% with against a forecast of 0.8. And you can see last month we actually had a recede in the number from 2.5 to negative 0.9, and then back up to 1.6 for this month. So again, above forecast. That should looks pretty good there. All right, so I got 3 articles I'm gonna blaze through real quick. I'm gonna try to make this fast. I have a hot dinner date with the wife as soon as I finish this up. Stocks rally, oil dips as investors eye Russia-Ukraine sanctions. Written by Sinead Carew from Reuters. Stocks around the world were rebounding on Friday, and U.S. Treasuries were out of favor as investors welcomed coordinated Western sanctions on Russia that targeted its banks but did not block it from a global payment system and left its energy sector largely untouched. Yeah, we're still buying oil and gas from Russia here in the United States. So I don't know if, we're really putting a whole lot of pressure on their economy. Oil prices were lower Friday as concerns about supply disruptions eased a day after oil surpassed $100 a barrel for the first time since 2014. European shares rallied and Wall Street indexes extended Thursday's rally. However, indexes were still down significantly from where they were at the end of last week. Actually, we know that they finished up. The international or the world index was up 2.18 on Friday, but down for the week after investors sold off earlier in the week due to Russian President Vladimir Putin's decision to attack Ukraine. Putin on Friday urged Ukraine's military to overthrow its political leaders and negotiate peace, as authorities in Kiev called on citizens to help defend the capital from a Russian assault. Its mayor said had already begun. EU countries agreed to freeze European assets belonging to Putin and his foreign minister, Sergei Lavrov, on Friday, as Ukrainian President Volodymyr Zelensky pleaded for a faster and more forceful sanctions. The United States was also expected to impose sanctions on Putin as soon as Friday, according to a CNN report citing people familiar with the decision. Some investors, however, were worried of the quick return to favor of risky assets just weeks before the U.S. Federal Reserve is expected to raise interest rates. The market is purely looking at the short run, saying that what they feared has happened, so there's nothing else to fear on the invasion of Ukraine. That being pretty short-sighted, said Chris Zaccarelli, Chief Investment Officer at Independent Advisors Alliance in Charlotte. Zaccarelli is turning his focus on what the Federal Reserve is going to do. That's a larger threat to the markets. The Fed is going to have to raise rates to a higher level than people believe in order to combat inflation. I've been saying that for months. We already talked about the Dow Jones. Oil prices fell as investor nervousness about supply disruptions eased. Brent crude was last at 97.76 per barrel, down 1.33, while U.S. WTI settled down 1.3% at 91.59. Safe haven gold dropped 0.7% to $18.89.94 an ounce on Thursday, and it had jumped to $19.73, its highest level since September of 2020. So it dropped about $100. over the course of a day. So, people got nervous. They flocked to gold. They saw it's not as bad as they thought it would be. And then they move out of gold and go back to their stocks. Reflecting on relative calm in the financial markets, yields on the 10-year Treasury steadied after a slide to 1.846 in the previous day's session. The yield on the 10-year Treasury notes was up 1.9 basis points to 1.991. The yield on the 30-year Treasury bond was up half a basis point to 2.298%. The 2-year U.S. Treasury yield, which typically moves in step with interest rates expectations, was up 5.4 basis points to 1.6%. After some dramatic moves in the foreign markets on Thursday, currency prices were much calmer. The U.S. dollar dipped a day after notching its biggest one-day percentage gain in more than 3 months as investors gauged the latest round of sanctions on Russia, and U.S. inflation data was viewed as likely to keep the Fed from being overly aggressive at its next policy meeting. So, yeah, everybody's worried about the Fed, and that's with what the Fed's going to do. The people in the stock market don't want the Fed to raise interest rates because that hurts valuations for growth stocks, and they'd like their growth stocks to continue growing. But for the sake of the American people and the economy, we got to raise interest rates because inflation is out of control, and you can't make any money on your savings. From CDs to bonds. I mean, there's just no yield there that's worth it right now. And then they get paid back in U.S. dollars, which, hey, who knows where they're going to be in 5 or 10 years. So, and then, back to the Russia-Ukraine thing, my personal perspective on this is, this is, a lot of a creation of the West. Back in 2014, the Americans helped, put Zelensky in power. And, now we're saying that, or now the media and the government is saying that, Putin wants to come in and install his own puppet government. Well, what the hell have we had for the last 8 years? I mean, we've had our own puppet in place. Whether or not, what sort of chicanery has been going on behind the scenes between the people, our politicians and the big shots in Ukraine, I have no idea. I can speculate all day long, but I have no clue. So maybe Putin's going to come in and clean house and spill the beans on all the bad stuff that's been going on from that our government's been doing. So, but hey, I don't know. All right. Next article I have, why Wall Street is much more worried about Powell than Putin. So let's shrink that down a little. All righty. Crying havoc, Vladimir Putin has let slip the dogs of war, both in Eastern Europe and the global financial markets. Thursday, the breathtaking comeback on Wall Street, roiled by panic selling stemming from Russia-Ukraine conflict, signaled how emotional investors have become in the era of high inflation and worldwide instability. One particular example of online gallows humor, useful during grim and tumultuous times, was particularly accurate on Thursday as Twitter meme referred to the Russian president as the world's most influential portfolio manager. All right. Given the pandemonium of Russia's offensive against Ukraine has unleashed and Wall Street's violent reaction, the joke was perhaps a two-bit on the mark. Meanwhile, Putin is fashioning himself as more of a modern-day czar than a chief investment officer. That's a bit extreme. All kidding aside, Thursday's deadly serious events and the resulting roller coaster price action provide us with an opportunity to revisit one particular theme that should remain paramount. Amid the bedlam taking place across the Atlantic, it's too easy to lose sight of the fact that the demand for the world's largest economy remains strong enough. It's debatable. To keep inflation uncomfortably elevated, and that runs the risk of making Federal Reserve Chairman Jerome Powell trigger happy at the central bank's next policy meeting. The Russia-Ukraine crisis is going to cause the Fed to be a little bit more thoughtful, a little slower in their rate increases. People's United Chief Investment Officer John Traynor told Yahoo Finance Live on Thursday, but we do believe the trend is still up with the Fed. Yeah, again, these people in the banking sector and the market makers really do not want the Fed to raise rates. And if that hasn't been abundantly clear with all the articles I share with everybody, I don't know what to say. In fact, Fed policy is a subject of virtually every discussion about the market's direction. Whether policymakers can successfully arrest surging inflation is one of the reasons why crude oil, which briefly spiked above $100 a barrel Thursday, has become one of the biggest concerns emanating from the Ukraine crisis. JP Morgan Chase forecast Brent could surge to 115 a barrel by the second quarter. Higher rates typically mean lower valuations, said Brad McMillan, Chief Investment Officer of Commonwealth Financial Network, noting that the forward price earnings ratio for the S&P 500 has tumbled precipitously since the end of 2021. That decline pretty much explains the drop in the market, and the rationale doesn't leave much, if any, room for worries about Ukraine, McMillan added. Wall Street then seems to be much more worried about Fed Chairman Jerome J. Powell than Vladimir Putin, at least at the moment. To be sure, economic consequences of the incursion in Ukraine are substantial and include more Western restrictions on Russia's natural resources industry that curtail global supply. Let me get down to the meat and potatoes here. Current financial situation, geopolitical. So, yeah, again, he spends more time talking about Russia than he does talking about the Fed when the article was about the Fed. So, as a result, we don't expect geopolitical risks to stop at the FOMC from hiking steadily by 25 basis points at the upcoming meetings, though we do think that geopolitical uncertainty further lowers the odds of a 50 basis point hike in March, Goldman noted. See, again, they do not want interest rates to go up by 0.5% in March. Definitely don't want it to go up by 1% by July, which is what St. Louis Bullard, I believe he's the St. Louis Fed chair. He is very much a hawk, wanting to get rates as high as possible. A tight labor market and still high demand is fanning the growing risk that the Fed officials want to see a faster slowdown in output and employment growth, and will act to tighten financial conditions more aggressively to slow growth to potential. So, all righty. So we can see that, like I said, those in charge really do not want interest rates going up. So we'll see, but anyways. All righty. One last article I got here. This is just some interesting news that has not made the headlines anywhere. I forget where I saw it. Credit Suisse faces fresh scrutiny over culture after client data leaks. So I don't know if you've heard about this. This was published on Tuesday. All right. So let's dive in. Credit Suisse is facing fresh scrutiny from Swiss regulators and European Parliament after leaked data purported to show the bank had served human rights abusers, corrupt politicians, and businessmen under sanctions for decades. The Swiss bank has denied any wrongdoing and said it strongly rejects the allegations published by dozens of global media outlets following a coordinated investigation. The leak of client data was initially sent to a German newspaper before being picked up by the Organized Crime and Corruption Reporting Project and 46 other news organizations. Credit Suisse said the ensuing report, entitled Swiss Secrets, detailed predominantly historical matters and was based on partial, inaccurate, or selective information taken out of context, resulting in tedious interpretations of the bank's business conduct. Approximately 90% of the reviewed accounts are closed or were in process of closure prior to the receipt of the press inquiries, of which over 60% were closed before 2015. Swiss regulator FINMA said that it was aware of the articles, though couldn't comment on individual media reports. We can't confirm that we are in contact with the bank. In this context, compliance with money laundering regulations has been our focus of our supervisory activity for years now. We refer to FINMA's measures and procedures in the context of combating money laundering in recent years. Meanwhile, the European People's Party, the conservative group commanding the largest numbers of seats in European Parliament, on Monday urged the European Commission to reevaluate Switzerland as a high-risk money laundering country, suggesting it could be included on the EU's blacklist for countries notorious for laundering dirty money. Woo! So, all right, there's a little bit more here. So just if you want to read it, it's attached in the show notes. So like I said, who knows what kind of ripple effect that might have with the financial services industry. Credit Suisse is a major player around the world. So maybe nothing, maybe something, who knows. But I did want to share it with everybody so that, if you want to talk about it with me, feel free to give me a buzz anytime. And that's about everything I had for today. So if anybody needs anything from me, don't hesitate to drop me a phone call or an email. And I'll be back on Monday with the weekly update. And I'm about to head out. So everybody have a great weekend, and I'll talk to you then. Bye-bye.